silence the noise for 2 minutes because silver just crossed a line. Most people think they're positioned, but they're not. When a metal breaks $100, it isn't a headline, it's a supply chain alarm. It separates price watchers from cycle builders, and it forces everyone to reveal their strategy. Tap like and subscribe right now because these moves don't wait. You'll want the next breakdown before the crowd shows up. Turn on the bell so you don't miss it. Quick note, this is education, not personal financial advice. Verify everything with filings and professionals you trust. The goal is clarity, not hype. Here's the trap. ETF holders celebrate linear gains while miners set up amplified gains. Same theme, different engine. One tracks price, the other scales profit. This week, one producer delivered the kind of evidence markets respect. Not a rumor, not a chart, real output. Production is the scoreboard in this business. America's gold and silver reported about 2.65 enameler ounces in 2025 versus 1.74 malers in 2024. That's roughly 52% more metal sold. Volume like that changes valuation models. Higher volume during higher prices changes everything. It turns survival mode into cash flow mode. And cash flow buys optionality. The stock hit fresh highs and spiked fast. That's often the preview, not the main act. The real repricing comes when guidance lifts. ETFs are built to track spot, so your upside is mostly 1-to-1. If silver rises 10%, you usually get about 10%. That's clean, but it's capped. People also get fooled by share price optics. A $30 ETF isn't cheaper than a $300 ETF. Price per unit is just packaging, and what matters is tracking, liquidity, and fees. A small annual fee can quietly shave real returns over time. Spreads matter too when markets move fast. Now compare that to a producer's income statement. Revenue rises with price, but many costs rise slowly. That gap is where leverage hides. If costs sit near $18 and silver goes $50 to $100, margins jump hard. That's not linear, it's operating leverage. It can turn a modest mine into a cash machine. Then add more ounces, and the curve bends again. Higher margin times, higher volume is how earnings surprise. That's why analysts get caught flat-footed. That's why miners can move 3x when silver moves 1x. You're buying an amplifier, not just exposure. But you must respect the settings. But amplifiers cut both ways, so discipline is mandatory. Bad operators can hurt shareholders even in bull tapes. Leverage without controls is chaos. The key divide is producers versus maybe someday stories. Cash-flowing mines behave differently than hope stage exploration. One pays you now, the other asks for patience. Another factor, silver supply can't scale overnight. Much of it is mined as a byproduct of base metals. So silver's supply response is delayed by design. So even if silver is expensive, new supply takes years. Permits, equipment, and geology don't speed up for anyone. A discovery is not production. That's why deficits can persist longer than people expect. The market often clears through price, not through output. Tightness shows up in delivery windows. Demand is also structurally sticky. Solar, electronics, EV systems, and grid upgrades keep pulling ounces. These trends don't reverse on a dime. Manufacturers can thrift silver at the margins, but total demand can still rise. More units built means more metal used. Efficiency doesn't cancel scale. Policies can tighten the pipe even more. When nations prioritize strategic materials, flows change. Regulations can redirect supply overnight. That's when physical premiums show up. The screen price can lag what buyers pay in the real world. Scarcity always charges interest. In tight markets, a 20-30% premium isn't rare. It's a signal that availability matters more than quotes, and premiums can move faster than spot. Miners sell real product into real bids. Contract terms can improve when refiners compete for supply. Better terms mean better cash flow per ounce. So a producer's realized economics can strengthen before headlines do. Earnings prints are where that truth lands. Numbers beat narratives every time. Now go back to that 52% production jump. Analysts modeling $30, $50 silver must rewrite their math. Rewrites are where re-ratings begin, rewrites trigger upgrades, and upgrades pull in bigger money. In a small sector, that flow hits like a wave. Liquidity becomes the catalyst. That's the liquidity mismatch. Large capital, limited shares. Prices can gap simply because there's nowhere else to go. This is why rallies look sudden. So how do you approach this without gambling? You build a basket with rules. Rules protect you from your own emotions. You size positions so you can hold through drawdowns. If a dip forces you out, you are oversized. The market punishes fragile sizing. Start with what you can verify. Ounces, costs, debt, and share count. If the numbers don't exist, skip it. If the numbers look fuzzy, dig deeper. Then check incentives, insider ownership, and dilution history. Great geology can still be a bad deal. Share count is a quiet drag. Next, check jurisdiction risk and permitting clarity. A good mine in a messy rulebook is fragile. Politics can change the math overnight. Also check the balance sheet for stress points. Debt can turn a pullback into a forced financing. Covenants matter more than vibes. Miners are leverage tools, not magic tickets. The upside can be huge, but it must be earned. Treat them like power tools. Use this fast checklist before you buy any symbol. It filters noise and saves time. It also keeps you consistent. Number 1, costs and margins. If costs aren't competitive, leverage becomes liability. Look for proof in quarterly results. Number 2, real production. Favor companies selling ounces today, not only presentations. Output plus guidance beats hype. Number 3, capital discipline. Strong balance sheets and aligned management survive volatility. Avoid serial dilution when possible. Now let's turn that checklist into a real positioning plan. This is where most people either win or wash out. Structure beats luck. Block 2. Step 1 is separating core from torque. Core tracks the metal, torque is the miner sleeve. Mixing them on purpose reduces stress. The core can be physical or a simple tracker. The torque is where operating leverage lives. Think stability first, upside second. Diversify by business model, not just names. Producers, royalties, and selective developers move differently. Correlation drops when models differ. Royalty and streaming firms collect a slice without running mines. They can reduce certain operational surprises. But valuation discipline still matters. Producers offer the cleanest leverage but carry site risk. One disruption can hit the stock even with strong silver. That's why you diversify. Developers and explorers are optionality. They can explode on good news or slump on delays. Keep that bucket smaller. So build in layers, sturdier names first, optionality last. That's how you chase upside without chaos. It's boring, and it works. When someone says, too late, ask a better question. Are supply constraints and demand drivers still intact? That's the real signal. Cycles often end when supply floods in. Silver's byproduct nature can slow that response. Slow supply can mean long trends. Watch physical signals, not just charts. Inventories, delivery times, and lease rates tell the story. Those indicators lead sentiment. Also watch miner behavior in filings. Debt paydowns and buybacks beat endless share issuance. Shareholder-friendly actions compound. A production surge only matters if it's profitable. Look at grades, recoveries, and cost trends. Free cash flow is the scoreboard. One record quarter is nice, but consistency is the goal. Sustainable run rates drive guidance upgrades. Consistency earns higher multiples. Guidance is a market-moving event. Higher targets with high prices can reprice future cash flow. That's how the sector wakes up. Now, stop obsessing over ETF share price. A split doesn't create value, and neither does a low unit price. Track what matters. Focus on structure, custody, spreads, and fees. In fast markets, execution costs matter. Liquidity saves you in chaos. Futures-based products can lag spot because of roll costs. That drag is invisible until it hurts. Know what you own. Physical metal has spreads and storage costs, but premiums can reveal real tightness. Availability becomes the feature. For many, the clean approach is a blend. Core exposure plus measured leverage. Blend reduces regret. The biggest enemy is psychology. People chase green days and panic on red ones. Miners will test your nerves. Build positions in tranches, not in one click. Give yourself room to be early, not perfect. Tranches smooth your entry. Keep your horizon aligned with the cycle. Supply responses and industrial demand play out over years. Short horizons create bad decisions. A simple rule. One miner should never decide your future. If it can, your sizing is wrong. Concentration is a hidden risk. Another rule, track share count like a hawk. Dilution is a tax you don't control. Rising prices don't fix dilution. Compare per share results over time. Growth that doesn't show up per share is noise. Per share is reality. Here's why institutions matter in this sector. It's a small pond, so modest inflows move prices. The pond can overflow quickly. Big allocators buy baskets, not stories. Liquidity concentrates moves into a few names first. Leaders move before laggards. Then momentum spreads into mid-caps and juniors. By the time headlines hit, the easy entry is gone. Early work matters. That doesn't mean you chase today. It means you prepare before the crowd decides it's safe. Preparation is your edge. After this video, pick 5 producers and read the last quarter. Write down output, all-in costs, and net debt. 3 numbers, real clarity. Then check where they operate and how permits work there. Political surprises can beat commodity trends. Risk isn't only price. Look at insider ownership and compensation. Incentives steer capital decisions. Alignment is underrated. Map the catalyst calendar, earnings, guidance, refinancing, and milestones. Catalysts move prices faster than opinions. Calendars beat feelings. If silver stays elevated, earnings can force re-ratings. That's when narrative becomes numbers. Multiples expand fast. If silver pulls back, quality matters more. Healthy balance sheets survive dips and buy assets cheap. Weak balance sheets get exposed. Remember why silver is unique. It's industrial demand plus monetary demand. That dual role creates sharp repricings. 2 engines, 1 metal. Metals move in waves, and miners move in amplified waves. Your job is to catch the wave, not every ripple. Patience is a position. So what does a 50% plus production increase signal to you? Expansion story or one-off boost? This is the question to debate. Are you positioned in a tracker, physical, miners, or a mix? Put your answer in the comments. I read them all. If you want, I'll break down a sample watch list method. I'll also show red flags hidden in filings. No fluff, just checklists. Type watch list if you want that next. And tell me which minor metrics you care about most. Costs, debt, or growth? Stay sharp, stay patient, and keep the rules. The market rewards preparation, not adrenaline, especially in metals. Because when the sector re-rates, it happens fast. The only question is whether you are ready. Don't wait for permission.